Welcome to Morningstar. I'm Holly Black. With me is Philip Harris. He's manager of the Eden Tree Responsible and Sustainable UK Equity Opportunities Fund. Hello.
Good morning to you.
Now, Philip, that fund name is quite the mouthful, and also it's recently changed, hasn't it? So, do you want to tell us briefly what the fund does and how it has changed?
Yeah, definitely. It's now obviously ethically screened. So we're looking at a responsible and sustainable tag. So we're looking to screen the fund, obviously, to get out for negative criteria, such as alcohol, tobacco, but also look as positive criteria as well. But the underlying dynamics of the companies that we look at haven't changed at all. We're still a growth fund. We're still looking at high quality businesses, high returns on capital, high margins, and good cash flows. So that bit hasn't changed. We're just screening the fund now.
And there has been a huge uptick in interest in responsible investments. Is that what's driven that name change?
Yes, it has. I mean, Eden Tree has a very much a historic focus on this area, and there were two unscreened funds in the firm, which this was one of them. So obviously it was a natural progression to change what was an unscreened to a screened fund, and obviously in line with what our clients are looking for.
And did you have to make many changes to the portfolio as a result?
Surprisingly not. I mean, we did have to obviously remove things like British American Tobacco, some of the oil and commodity stocks. So in the sort of FTSE stocks, yes. In the small cap stocks, only one stock particularly went, which is Morses Club, which is a high interest lender. So actually the changes in terms of the total percentage of the fund were relatively small.
And it's a UK-focused fund, obviously. We know that a huge chunk of the UK index is oil and energy and commodities. So how difficult is it to marry up UK investing with a responsible remit?
It's actually very easy. I mean, a lot of the sort of big old-fashioned oil and those sort of type companies are in secular decline. The fund's always been massively focused on mid 250 and small cap stocks. So roughly half the fund is in those stocks anyway. There are some really good stocks in the FTSE that meet our criteria as well, like Ashtead. So there's lots of opportunities to invest on an ethical, sustainable basis and to avoid what we think of those secular declining stocks. So no, it hasn't been an issue at all.
And you talk about the small and mid-cap space there. Obviously, it's had a tricky time for the past few years, but it seems like the tide might be turning. What are your thoughts on that?
It's an area that I specialise in. I have for my 30 years in the city. It's an area we think there are some huge and significant opportunities. The lack of research, the lack of broker contacts for a lot of these companies mean there's some real, sort of uncovered gems out there, and that's why we focus on them. And I think our sort of investment performance over the last few years shows that this is a great area to go and to invest into and actually make a lot of money for our unit holders in.
And what do you think some of the biggest tailwinds to investing in the UK are at the moment? Because again, an area that's been out of favour for a while.
Yes, it's a very good question. And clearly, Brexit and obviously then the pandemic has basically put a problem and issue for a lot of UK companies. But there's a hugely diverse and great base of UK companies out there in that small and mid cap, exporters, home delivery companies, all sorts of interesting growth markets. So there's a great opportunity now that some of those uncertainties have gone to actually invest there. Not all of those uncertainties have gone. We still have some issues over Brexit with the Northern Ireland Protocol. We obviously have the recovery from the pandemic, which is still working through. But we're very confident there's some really, really good businesses out there that we can, get some great growth opportunities over the next 5 to 10 years.
And are there any areas that you tend to be more cautious over, not just because of the ethical screen?
Yeah, I mean, we don't like sort of asset-intensive businesses, so not just obviously, as we talked about, the oil companies, anything with lots of assets, anything that's a sort of value business that's got old-fashioned assets that earn low returns. We like asset-light businesses that say high returns on capital, modern businesses that are capable of growing. So that's the sort of thing we look at. Anything that's not capable of being a materially bigger business in 5 years is something we would avoid.
And obviously, home working, homeschooling, home delivery, these were the big trends of 2020. What do you think are going to be the big trends for investors for the year ahead?
I think there are some big, big changes coming through, and you've highlighted some of them for 20. A lot of the things like home working still and the way we work and the way we shop, those are the things that we're still actually working through. So many of the trends that became apparent or accelerated probably in 2020 are still going to be very prevalent this year. So, we're all going to be working from home, potentially part-time, even in the future. When we go back to the office, we may go to a flexible office, not a modern office. So all of those trends have big opportunities and big risks for certain companies and how they adapt, but that's the opportunity to find some interesting investments in those sort of areas.
Philip, thank you so much for your time. For Morningstar, I'm Holly Black.